and to talk about ideas, talk about what's going to happen, not what has happened, and not about personalities and not about name calling, because both sides are pretty good at all of that stuff. And the fact that I sit down with either one of these candidates is going to piss some of you off. And
are you still relying on outdated investment strategies? In today's uncertain world, sticking to the traditional 60-40 rule might leave you exposed to risks you can't afford. If you're not diversifying your portfolio, you're missing out on crucial opportunities. The financial landscape is changing. Don't be the last to adapt. Stay ahead of the game and learn how to future-proof your investments. Watch this video now to make sure you're not left behind in the next market crash. Diversification. In 2025, financial experts warn that relying solely on traditional assets, like stocks and bonds, may no longer provide the stability investors need in uncertain times. A new trend is emerging, embracing diversification beyond traditional assets. Investors are turning to alternative options such as real estate, infrastructure, and commodities. The value of these assets often moves differently than stocks, providing a hedge against market volatility. Celebrities like Oprah Winfrey and Robert Kiyosaki have advocated for such investments, stressing the importance of reducing risk through diversification. They believe this approach gives investors more control during financial downturns. As uncertainty rises, the world of investments is evolving, and it's clear that a diversified portfolio is key to long-term resilience. Experts urge investors to explore and balance these assets to build stronger, more resilient portfolios. 60-40 split. In 2025, the traditional 60-40 portfolio allocation is under scrutiny. This classic formula, which involves 60% stocks and 40% bonds, was once considered the gold standard for balanced risk. However, market conditions are changing. Experts argue that this split may no longer work in today's unpredictable world. With interest rates rising and stock markets showing volatility, many investors are questioning the effectiveness of this approach. Celebrities like Warren Buffett and Elon Musk suggest that diversification and alternative assets might be the future. As global uncertainties grow, it's clear that investors need to rethink their strategy and consider adjusting their allocations for greater resilience. The 60-40 model might have worked in the past, but it may not be the best fit for today's market. Climate risk. In 2025, integrating climate risk into investment strategies is becoming essential. Investors are now more aware that environmental changes can affect financial markets. Extreme weather events, shifting regulations, and the growing focus on sustainability have made climate-related risks a crucial factor in portfolio management. Influential figures like Greta Thunberg and Bill Gates have advocated for investing in companies that prioritize environmental responsibility. They argue that understanding the financial implications of climate change is key to protecting investments. With rising global temperatures and unpredictable weather patterns, climate risk is no longer a distant concern. It's something that affects portfolios now. Investors must rethink their strategies to safeguard against these risks and align their investments with a greener future. Goals-based. In 2025, more investors are shifting towards goals-based investing. This approach focuses on aligning investments with specific financial goals rather than just maximizing returns. Instead of aiming for general wealth accumulation, investors are setting clear objectives, like saving for retirement, buying a home, or funding education. By focusing on these goals, investors can make more calculated decisions and reduce unnecessary risks. Celebrities like Oprah Winfrey and Dave Ramsey have highlighted the importance of financial goals in creating long-term wealth. They emphasize that understanding one's financial aspirations leads to smarter investments. In uncertain times, this method offers clarity and ensures that investments are directed toward what truly matters, helping investors stay on track regardless of market volatility. Tail risk. In 2025, many investors are considering tail risk parity strategies to protect their portfolios. Tail risks refer to rare but extreme market events, like financial crashes or sudden economic downturns. Traditional portfolios often leave investors vulnerable during such times. Tail risk parity aims to balance risk across different assets, ensuring that no single asset class dominates during an economic shock. Experts like Ray Dalio and Nassim Taleb have discussed the importance of preparing for these rare but impactful events. They argue that without a strategy to address tail risks, investors can face devastating losses when the unexpected happens. By implementing these strategies, investors can build a more resilient portfolio, ready to withstand extreme market conditions. Principled reasoning. In 2025, more investors are turning to principled reasoning when making investment decisions. This approach emphasizes using fundamental economic principles to evaluate potential risks and rewards, rather than relying solely on trends or short-term gains. By focusing on core values such as sustainability, fairness, and long-term stability, investors can create a portfolio that aligns with their ethical beliefs. Influential figures like Elon Musk and Jack Dorsey have championed this type of thinking, urging people to consider the broader impact of their investments. As market conditions become more uncertain, principled reasoning helps investors navigate complexities with a sense of purpose. This method not only aims to protect financial assets but also ensures investments contribute to a better future. Liquidity. In 2025, maintaining liquidity is becoming a crucial aspect of building a resilient investment portfolio. Liquidity refers to the ease with which assets can be converted into cash without significant loss of value. Experts emphasize that keeping enough liquid assets, like cash or short-term bonds, can help investors navigate unexpected financial needs or capitalize on sudden market opportunities. Celebrities like Warren Buffett have long recommended having cash reserves, especially during times of uncertainty. With global markets facing unpredictable events, maintaining liquidity provides a safety net and flexibility, allowing investors to adjust their portfolios as needed without being forced to sell assets in a downturn. In today's volatile financial landscape, liquidity is a key factor in ensuring both short-term stability and long-term growth. Hedging. In 2025, many investors are turning to hedging strategies to protect their portfolios against unexpected market movements. Hedging involves using financial instruments, like options or futures contracts, to offset potential losses in other investments. As market volatility increases, celebrities like George Soros and Ray Dalio have advocated for hedging techniques to shield portfolios from extreme downturns. For example, options allow investors to lock in prices for future transactions, providing a safety net in case of unfavorable market conditions. With geopolitical tensions and economic uncertainties growing, hedging is becoming a vital tool for protecting investments. By incorporating hedging strategies, investors can reduce risk and help ensure their portfolios remain resilient during times of market instability. Rebalancing. In 2025, regular rebalancing of investment portfolios is being recognized as a key strategy for maintaining financial health. Rebalancing involves adjusting the portfolio's asset allocation to align with an investor's evolving goals and market conditions. As market fluctuations cause certain investments to grow or shrink, rebalancing ensures that the portfolio remains aligned with the desired risk and return objectives. Influential figures like Vanguard's Tim Buckley have long recommended this practice, noting that it helps investors maintain a disciplined approach, especially during periods of volatility. By regularly reviewing and adjusting their portfolios, investors can stay on track to achieve long-term financial goals. In uncertain times, rebalancing offers investors the flexibility to adapt, keeping their portfolios resilient and well-positioned for future growth. Don't miss out on the next big opportunity. Make sure you're ahead of the curve. If you found value in this video, subscribe now and hit the bell so you never miss an update. Trust us, you won't want to miss our next video on upcoming topic. Stay tuned and get ready to invest smarter.